All right, hey everyone. We decided to do a video to share with everyone about the infinite wisdom of Warren Buffett. With right now with the market being a little bit more volatile, especially in August and September, where historically we will see a little bit more volatility in the market. For example, last year we had the yen carry trade, right? So I decided to do this video to prepare all of you to stay grounded and to stay prepared to make sure that your mindset is always steady, especially in volatile times. And this will also help you not just in periods like today, but also in throughout your investing journey. Let's get started. All right. Warren Buffett, I'm sure all of you know him, right? He's been investing for over 8 decades now. He's accompanied by his right hand man, Charlie Munger, right? So Charlie Munger, Munger actually met Buffett back in 1959, and they quickly became partners, right? And to them, right, what is their approach is very simple: is to buy wonderful businesses at fair prices, not just cheap ones. Invest in companies with strong competitive advantage and hold businesses for the long term and let compounding do its work. So it is these three approach that they used to build Berkshire Hathaway, the power that we see today. So as you can see, right, this is how they have grown the Berkshire Hathaway until where it is today. So whatever I'm sharing here today is from the lens of a legend who has been there, done that, and with actual results to prove for. I mean, just look at their website. It is as simple as it gets, right? Straightforward, nothing fanciful, no fancy words. It is just the SEC filings, the message, the annual reports, and the letter. Now, I've read through his annual letters already, and here are these top three learnings I've taken away to help you navigate through any market volatility that you will experience. The first one is simple work actually works. Okay, so what do I mean by this? So what Warren Buffett says is lethargy, bordering on sloth should remain the cornerstone of an investment style. And this is in his 1990 shareholders letter. So let me share with you a story about this, right? So on back in 2007, right, Warren Buffett actually made a bet with an asset management firm called Protege Partners. And his bet was that the S&P 500 will outperform a group of actively managed hedge funds over 10 years. So basically, right, the protege actually selected five investment experts who in turn employed several hundred over investment experts managing their own funds. So it's like a five fund of funds. So they in turn in total is over 200 hedge funds. So these hedge funds, right, they also had this advantage where they could rearrange the portfolio anytime during these 10 years. So they can always move with new stars while removing the old stars. Whereas Warren Buffett simply just invested in the S&P, and it was a $1 million bet. So how did it actually fare? Let me show you the results, right? So you can see that throughout this 10-year ending in 2017, right, the S&P 500 actually achieved 125% return as compared to the respective fund, and even the best performing fund, Fund C, did 87.7%, whereas the worst fund, right, Fund D did 2.8%. And if you take the average of these five funds, they actually performed 36%. So what can we take away as investors, right? So the most important thing is that simplicity and patience often outperforms complexity and constant tinkering. Many times we think we need new strategies, different approach, or the latest market insights to succeed. But the truth is actually the best strategies are already what we know, right? Buy great businesses, hold them, and let time do the work, right? Even if you use some certain option strategies, even the simplest one works, right? Many times investors often feel not because they don't know enough, but because they don't trust what they already know. They find it boring, and they always like to go and try new shiny things, and then end up realize that actually it's not suitable. And the best one is what they have always been executing. So instead of chasing what's new, focus on executing what already works and have the patience to let it play out. Now, the second lesson is what I call contrarian investing. So, contrarian basically means opposite. So, example, people ask you to eat, you go and sleep. People ask you to sleep, you go and eat. So, just opposite. Now, let's look at and simply what Warren Buffett said is be fearful when others are greedy and be greedy when others are fearful. Now, let's look back to what Buffett did during one of the biggest financial crises the world has seen. And you guess it right, it is actually the '08 financial crisis, right? The crash of Lehman Brothers. And you can see this was what was dominating the whole. Everyone thought the world was going to end at that point in time. But what did Buffett do during this time when everyone was so scared and think like the world is going to fall? Warren Buffett actually did invested $5 billion in Goldman Sachs amidst the global financial crisis, capitalizing on undervalued opportunity. And what he said was that it's a very, very strong, well-run businesses. They have a very strong market position, and you cannot find a better manager at that time. And he also said this, right, that it's not just him having confidence or what we call conviction in Goldman Sachs. He was also confident that they will not unnecessarily drive over a cliff without the US government doing the things that it should. So this is something which he did, which is called conviction, right? Being greedy when others are fearful. When everyone is telling to run out the door, this is where you stay grounded and you look at the quality businesses and you assess in 10 years, 15 years, where will it be? And this paid off very, very well for him because he actually made $3.1 billion on this bet on Goldman Sachs, right? So this is proven. This is not some random things that we went out. He put in 5 billion, he hold through it because of the quality business and came out strong, right? $3.1 billion. So what is the key takeaway over here for number two is that when he invests in 2008 in Goldman Sachs, right, it wasn't about timing the market, right? He recognized a strong businesses with very strong value, despite this kind of a short-term news. And basically, right, when opportunities arise, focus on the quality of the business, not the fear in the market. So what did Warren Buffett focus on? He focused on the company's fundamentals, the leadership, and the resilience, right? Because as investors, right, we don't hesitate when great businesses go on sale. It's like our favorite shoe go on sale. We'll be so excited, right? So true investors will be very happy about it, right? They should step up with conviction. And the biggest rewards actually goes to those who are prepared, patient, and bold. Now, you might think that this is 2000, it's not applicable to us. Now, just look back in 2022 when the whole market was in a downtrend for the whole year. Well, at that point in time, if you just focus and you bought quality businesses, today, in just 3 years, you will be way up. Okay, like example, right? Taking any company like Palantir has done multiples from there. Even if you bought Microsoft, Google, then you have done very, very well. So the idea is not to be fearful. Instead, be very greedy when others are telling you to get out of the door. Now, at this point, I want you to pause this video right here, and I want you to, if you enjoy this kind of updates, right, this kind of insights, right, I would like to invite you to join our Telegram chat, Buffett Online School Telegram chat. So you can go to this link directly, or you can click the link in the description box down below. Alternatively, just take out your mobile phone and just scan this QR code over here. So when you join it, you get our all exclusive top 8 stocks watch list. It's a Q3 2025. We just updated it. And on top of that, it is also some latest update. For example, what you see on the left side, my partner Rachel sharing about what we call the September effect. So it's a lot more ideas you can get on the go, on the fly very, very quickly. So pause this video right here and join our Telegram chat and get this exclusive top 8 stocks watch list right away. Now let's move on to the third lesson, right, which is the virtue of patience. So what did Warren Buffett say, right? This is in his 1991 shareholders letter. He said the stock market is designed to transfer money from the active to the patient. Now let me share with you one more story. And this is actually the story of Berkshire Hathaway, right? So you've known Warren Buffett, you've known Charlie Munger, right, as they are the masterminds behind Berkshire Hathaway. But did you actually know that there was a third person with them? And this person is called Rick Gurin, and he was a third partner of Berkshire Hathaway, but he faded away in the spotlight. So Gurin was a very talented investor, and he co-invested in several deals alongside Buffett and Munger, and he created $9 billion in value for Berkshire Hathaway then. But unlike Buffett and Munger, right, his story took a very different turn. He wasn't just a brilliant stock picker. He was actually very, very aggressive. And what do we mean by that is that he actually used leverage to supercharge his returns. And when the market was soaring in the late 60s, right, his net worth actually surged past $50 million there. And it's a lot of money at that point in time. But then there came the crash of 1973 to 1974, and the market declined by nearly 70% over these 2 years. And because he did leverage, right, what happened to him? He faced margin calls. And to meet these obligations, Green was actually compelled to sell his Berkshire Hathaway shares to Buffett at approximately $40 per share. Okay, remember how much you saw Berkshire Hathaway price earlier, right? It is like 6 digit. Okay, and we are talking about Berkshire Hathaway shares class A, not class B, which is what you saw earlier. So he was compared to sell at $40 per share. And Buffett later explained about this, right? He said that Charlie and I always knew we'll become very wealthy. We were just in no hurry. Rick was just as smart as us, but he was in a hurry. And because of this impatience and over leverage, Green actually faded from the spotlight, while Buffett and Munger continued to build Berkshire Hathaway into the powerhouse that we see today. So, what is this takeaway that we have, right? Which is that never risk what you have for what you don't need, right? Patience always wins. While Buffett and Munger played the long game, Gureen tried to get rich quick and paid the price. Like a lot of things you see nowadays, a lot of trading things you see to say you can get rich very quickly. Well, let me tell you, when you find a get rich quick scheme, okay, you want to be very careful about it, because when you get money quickly, you sometimes might spend away very, very quickly. And so patience always win, right? The second thing is that you want to avoid leverage, right? Because when you borrow money that's not yours to invest, okay, you will be very in a tough position, especially when the market drop, which you don't know when will happen. And the last thing is to always stay rational in volatility, because the market will crash and recover multiple times. But those who stay steady, like Buffett, will end up winning. So, this is another chart that I like to end off with, right? Which is that stocks always go higher even with bad news. So the market may experience short-term turbulence due to geopolitical events or macroeconomic shifts, but when you zoom out, right, the long-term trend speaks for itself. So whatever that we go through, that is happening today, all the wars, all the short-term macro news, the tariffs, right? You want to zoom out and look at the big picture, right? That's why having a strong mindset and a long-term investment horizon is very, very crucial, right? And some might say that, hey, this is boring. But let me tell you, the boring way of investing works, because some people do not like very, very active, right? You might have to do a lot of things, and when you are spending a lot of time on this, right, know that what is the time you are giving up for. Okay, and know that the more time you spend on this, the more emotions is involved. But long-term investing, right, investing in quality companies and doing their perform, right, that is something like you can just leave your money and leave it to grow. And I'm not saying grow like 5%, 10%, right? Like you invest in great companies, right? Every year it can go up to 20%, 25%, right? So having this long-term investment horizon is very crucial. But that said, right, you must always invest in quality companies, because great companies constantly reach new all-time highs, and this reflects their resilience and ability to grow. So to end it off, right, this is one of Buffett's famous lessons from Graham, right, which is market fluctuations are your friend, not your enemy. Okay, so remember that fluctuations gives you opportunity to buy in, and it is not avoidance, right? So make sure that you are always how to position yourself. Like Howard Marks also say, you can't predict, but you can prepare. Right, we don't know what's going to happen in the next 1 or 2 months. Anything can happen, but whatever happens, you want to make sure that you are positioned. You want to make sure that you're not taking too much risk than as you are supposed to, right? You want to balance it out everything. Okay, so that's what I wanted to share today. And for those of you who didn't manage to join the Telegram, I'm just flashing it here one more time. So again, just scan the QR code on the right side over here, Buffett Online School. And once you join, you will get access to our exclusive top 8 stocks watch list that we just updated just a few days ago. Okay, so I'll see you inside the Telegram chat, and I hope that you have learned something here today. Cheers.